The Central Bank of Nigeria, at the end of its two-day meeting of the Monetary Policy Committee, decided to retain the monetary policy rate at 11.5% with the asymmetric corridor of plus 100 basis points minus 700 basis points around the MPR. Now, this is the fifth consecutive time the MPC will be retaining the MPR at 11.5%, as well as other key parameters unchanged. The committee maintains that the move is expected to allow further economic growth despite four-year high inflation after the country exceeded recession last year. At the fourth MPC meeting for the year, the committee noted that although the headline inflation remained above the CBN's target range of between 6 and 9%, the bank's intervention in various sectors of the economy will help push inflation on the downward trend. Among other key issues deliberated at the MPC meeting is the broad level of the insecurity across the country, which has impacted businesses one way or the other. Of course, confidence and overall economic activities, the improvement in the country manufacturing purchasing managers index, PMI, which grew to 46.6 index points in July 2020 compared to 45.5 index points in June 2021, as well as weak performance in the oil sector, which was attributed to several factors, including the declining quality of oil infrastructure, lack of new investments in the sector, and the need to comply with the OPEC Plus production quota. Mr. Ayodeji Ebo is the head retail investment at Chapel Hill, Denham. He joins me now via Skype. Mr. Ebo, good afternoon to you, Mr. Ayodeji. It's good to have you on the show this afternoon. Good afternoon. Can you hear me, Mr. Ebo?
Yes, I can hear you. Good afternoon. Thanks for having me.
Yes, a lot to take out of that meeting. Yes, for some time I've stayed with the FX side, and I want to move away from that. First is the reality on ground is the third wave of COVID-19, the Delta variant. NCC even recorded today that Nigeria has recorded more than 4,000. I kind of jump in figures in the past few weeks. Now, this will definitely affect growth domestically and of course globally. We know what's happening now. All of the projections that we've had before now, I am thinking as a layman, one way or the other, do you think there won't be reprojections or newer projections with all of the realities on ground?
Okay, thanks. You raised a very valid point, but I think that learning from the last lockdown, so if you do an analysis, you will discover that maybe we did ourselves more harm than even opening up the economy because of the way we are structured. We can't compare ourselves to the developed clients that have more structure in place. So I'm not saying leaving it all to allow it to escalate, but I feel that what we would see is just government trying to improve on creating that awareness, people believing that this is real and putting the check and balances in place. And thankfully there's the vaccination also. There's also a lot of work that government also needs to do on the part of convincing people to also take this vaccine. So I don't see a situation where there will be a major lockdown that will halt business activities, because when you look at the pros and cons, and we may do ourselves more harm by halting business activities. This rather than taking precautions, people using their face mask and doing the normal precautions to prevent the contamination of or the contact of the virus. So also playing a scenario, if things get worse, which we don't hope that it happens, then it will impact on the projections, because even a lot of the economy is even trying to just because a lot of the sectors are just trying to recover from the major crisis from COVID-19. But I think the most challenging, the most impact that we may see is if there's a major drop in oil prices. When oil-dependent economy, all government budget, most times when you look at the actual budget, largely depends on oil. So it's when if it escalates even globally, and we begin to see shutdown globally, and oil prices oil price begins to dip, then it will also affect fat allocation, which will also affect implementation of the budget. And at that point, then there would also need to be a major review in terms of our GDP projection.
A very good way to start the discussion, as usual, with you, Mr. Ayodeji. Now, let's now look at interventions by the central bank. Many times you see them reeling out all of these interventions from the agricultural space. At the moment, I think a lot in the creative space. The central bank is trying to even look away, not just agriculture, but the non-oil space, where they can just put some money and, of course, make more money. Now, what will be your assessment? A lot of money has been doled out to all of these sectors of the Nigerian economy. Impact is something that is key. What's your assessment? What are you saying? What are the feelers you're getting?
Okay, thanks. When we look at the figures that we have, mostly in terms of the disbursements, the number of people that have been able to benefit from this intervention fund, or the sectors that have benefited. Yes, yet to see any detailed analysis in terms of impact assessment, but we can see that we would say maybe on a relative basis there being a bit of impact. But when you look at the quantum of what the intervention funds as a proportion of the GDP, is still very minute. It's significantly less than 10% compared to our GDP. We look at the agricultural sector, which a lot has gone into that space. I know one major challenge that would affect the effectiveness of that is the insecurity. You know, a lot of the farm, most of this insecurity is affecting a lot of the farmers. And I believe that a lot of them would have also received these intervention funds, and most of their farms might all be unable to farm. So beyond that, I believe that if we see the data, there would have been an improvement in terms of the cultivation, improvement in cultivation of this food produce, which would increase the quantity available within the country. But you know, when you also look at the food inflation, is still on the high side, despite even the reopening of the border, which we expect that will bring down food prices. And secondly, if you look at looking at other sectors, we believe that they are also feeling that positive impact, because like the pharmaceutical sector, for instance, having that long-term funds at single-digit rate will be positive. We saw their first quarter earnings or their full-year earnings will also be positive to them. So I wouldn't say that there's really no impact that we're seeing from the intervention funds, but I will also expect that there should be like a detailed impact assessment that we're able to trace and see, before the intervention fund, this is the output, and now after the intervention fund, this is the output that we're getting within that sector in terms of profitability. That will also help us to put things into more proper perspective.
Moving on, report yesterday, the day before, shows that capital importation also declined to $876.6 million from $1.9 billion. We're talking about dollars here. That's in the first quarter, of 54.06% rate compared to the 32.28%. That's for the first quarter. But the thing is that NBS is noting that much of this capital importation was recorded through portfolio investments. What do you make of this? It seems to be a little worried about it.
Yes, I think it calls for a major concern, because we continue to see it on the downward trend on a year-on-year basis. But when you also want to look at the underlying factor, we know that in terms of the liquidity of the FX, it's not where it should be. And as a result, a lot of the foreign investors are not comfortable to come in at this level, because if you also look at it, there are still some foreign investors still trying to pull out their funds from the country. And you also look at the FDI, which is very critical to our development. That has also depleted significantly, and this is the long-term capital that should help generate more jobs. But when you also look at what the major underlying factor, insecurity, it's critical that we try to surmount or reduce the insecurity level in the country for us to be able to attract investment, because most of our neighboring countries are the one benefiting. So because the average producer will want to be close to market, because proximity to market is critical, and the best option for most of them, looking at ease of doing business, the security level, they choose neighboring countries, especially Ghana, and they try to import those things from those countries. So I'm not surprised that the volume of both FDIs and FDI have depleted significantly, but it's something that we need to come to see what we can do instantly, because you also notice the pressure that we're seeing on the FX can also be linked to the lower inflow of FDIs. The FDIs, yes, we call it hot money, but that is like the liquidity that helps to pushing the shock and reduce pressure on the CBN. So we need this. We need to provide confidence for the foreign investors to be able to bring back their funds, and especially long-term funds that would also help improve economic growth in the country.
Let's talk about the markets. Now we see half-year figures coming in, of course, but what's your entire assessment of what's been playing out recently? I still see that issue of investors' confidence is something that we still need to work on so very much. Mr. Ayo, how does that come to you?
Yes, thanks. I think we've seen more positive results than negative results. So I'm talking on a year-on-year basis now. When you look at the non-financial sector, so we've seen the positive growth, especially in their top line and also in their bottom line, and that's also responsible for some positive momentum that we see in some of these stocks in the market. And yeah, there are few ones, but when you also look deeper, you will discover that cost of doing business have continued to rise. Yes, for the let's say for the manufacturing sector, it's easier for them to immediately push the cost to the consumer, and that is why they are able to stay profitable. But in some sectors, you look like the beauty sector, is not also very easy for them to push those costs to the consumer because of the competition within that space. So, but by and large, we expect that to see more positive results, and because the economy, when you look at it on a year-on-year basis, this time last year the GDP was was down by over 6%, and that it was during the major lockdown. So with activities that have picked up, and we also look at it on the quarter-on-quarter basis, we know that activities have also picked up. So we believe that there will be some improvement, and for long-term investors, it still presents opportunities in stocks that have released, have been consistent in terms of their positive performance. We also know customary that half year we see some companies that also pay interim dividend. This also attracts a lot of investors to invest, which will increase the demand, and as a result, prices would also improve.
Now, almost wrapping up, back to our economic recovery. We have this document we worked with before now, which is Economic Recovery and Growth Plan. That's on one side. But I think with COVID, we came up with the ESP as Economic Sustainability Plan, where we have the export funds of about 50 billion. We have the survival, a lot of funds back to interventions again, away from the CBN, I think this time. I think this from the fiscal side. What would you say also about this, and how well would you say this is trickling down? Because Nigerians hear all of these figures, and some will even say they can't even access these monies. But some come out really to say they can access it. What do you really think?
Okay, thanks. I think what we've been seeing is we know when you look at the government's budget, we know there are constraints in terms of revenue. And when you even look at the actual performance, even as at May, you discover that debt servicing is almost over 90% of actual revenue now. So you'll see that there's little or nothing left for development. So looking at the intervention funds that the fiscal authority has made is also like a drop in the ocean. So I'm not surprised that we're not feeling the impact, because when you look at it as a proportion of the total economy, it's really very minute. You can even say that the CBN has, when you look at the total intervention fund from the monetary angle, is significantly higher than what we're getting. So all these policies, Nigeria, in this country, we don't lack policies. It's more about how do we implement them. And that's why you talk about the EGRP, you also talk about the ESP, how much of implementation has been done. And because when you see those documents, they look always very interesting and they excite us, but when it comes to implementation, we are always lagging behind. And maybe also in terms of the resources to also implement them, we also don't take that into consideration when we are formulating. So most times it's always back to square one, and you won't be surprised that maybe in the next few months there's another policy in terms of sustaining this economic recovery. But it always boils down to political will for us to implement these policies, and once we were able to implement, definitely we will see the results. Private sector has a major role to play. We cannot, on both domestic and foreign investors, and that is why we need to tackle insecurity, because even the domestic investors will not be happy to expand, will not be happy to set up actually when there's insecurity in the country.
Let's wrap up on this note. Now, the CBN has also said at that meeting that they've exhausted all arsenals they could use to stimulate the economy. A lot of policies, orthodox and unorthodox policies, have been instituted to support the Nigerian economy. Which way do you think we would go? Let's look at as we project towards the end of 2021. Any projections directly, or your group? What are you thinking? What do you think would happen? What scenario are we painting? And the good, medium?
Yeah, thanks. Thanks. Barring any escalation of the third COVID-19 third wave, we believe that we should be able to sustain the positive momentum, and we're still estimating over 2% at the end of the year. That's when you take the average, we're estimating over 2% growth rates at the end of the year. But we need to we need to tackle insecurity, because when you look at inflation rates, food inflation that accounts for over 50 or 50.7% of the total inflation basket, we're expected to go into the harvest season. But if you also look at it critically, how much of planting was done, especially in the food producing areas. So in terms of harvesting, it means that we won't see as much, and based on anticipation that prices would also reduce, we may not see as much impact from that angle. And you also want to look at the angle of the real sector. If we are not creating, if we are not expanding, if we are not creating more, if more companies are not setting up, employment will not improve, and as a result, we will not grow as much as we anticipate, because any growth rate that is below our 3% population growth rate, it means that there are a lot of people out there are also going into poverty. So the suggestion would be for us to first tackle insecurity, to build confidence, to have both domestic and foreign investors set up in Nigeria. We make agreements with major things that we know we import. We can agree with some of those companies to come in and give them incentive, and we look more of long run and long-term benefit than getting short-term benefit. And if we're able to implement that and we don't see any major shock, we believe that we'll be able to sustain this positive trajectory before the end of the year.
I must thank you very much, Mr. Ayodeji. He is the head of retail investments at Chapel Hill, Techham. Thank you for spending your afternoon with us. We appreciate this.
Yeah. Thanks for having me.